Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that might sound complicated, but it affects every single one of us, from our savings accounts to the price of our morning coffee. We're talking about central bank interest rate decisions. I know, it sounds like something straight out of an economics textbook, but trust me, understanding this is like having a superpower for your personal finances. So, what exactly is a central bank? Think of it as the big boss of a country's banking system. In the United States, it's the Federal Reserve, or the Fed. In Europe, it's the European Central Bank, or ECB. Their main job is to keep the economy stable. One of the most powerful tools they have to do this is by setting the main interest rate. This is the rate at which commercial banks, like the one you use, can borrow money from the central bank. Now, why should you care? Because this one rate creates a ripple effect across the entire economy. When the central bank raises interest rates, it becomes more expensive for your bank to borrow money. And what do? They pass that cost on to you. This means higher interest rates on mortgages, car loans, and credit card debt. Suddenly, borrowing money becomes less attractive. The goal here is often to cool down an overheating economy and fight inflation. When things are too expensive, raising rates encourages people and businesses to save more and spend less. This reduced demand can help bring prices back under control. So, if you've been groaning at the grocery store checkout lately, you can see why the central bank might decide to step in and hike rates. On the flip side, what happens when the central bank lowers interest rates? You guessed it, the opposite. It becomes cheaper for banks to borrow, and they pass those savings on to us. Mortgages, personal loans, and business loans all become more affordable. This is a move designed to stimulate the economy. When the economy is sluggish or in a recession, lower rates act like a shot of adrenaline. They encourage people to borrow and spend, and they motivate businesses to invest in new projects and hire more people. This can kickstart growth and get the economic engine humming again. So, a rate cut is often seen as a signal that the central bank wants to boost economic activity. Now, let's talk about the big one. Investments. Central bank decisions are like the weather report for the stock market. When interest rates are low, borrowing is cheap, which is great for companies looking to expand. This can lead to higher corporate profits and, in turn, higher stock prices. Also, with savings accounts offering very low returns, investors often look to the stock market for better growth potential, pushing prices up even further. But when the central bank starts raising rates, the mood can change quickly. Higher borrowing costs can squeeze company profits. Suddenly, that new factory or expansion plan looks a lot more expensive. This can make investors nervous, leading them to sell stocks. Furthermore, safer investments like government bonds or even high-yield savings accounts start to look more attractive as they begin to offer better returns. This flight to safety can cause the stock market to dip. It's a constant balancing act. The central bank is trying to navigate a narrow path. If they keep rates too low for too long, they risk creating asset bubbles and runaway inflation. If they raise them too high or too fast, they could slam the brakes on the economy and trigger a recession. That's why every single word from the central bank chairman is analyzed by traders and economists around the world. They're all looking for clues about the future direction of the economy. So, how can you use this information? It's not about trying to time the market perfectly. That's nearly impossible. Instead, it's about understanding the environment you're investing in. When you hear news about the Fed considering a rate hike, you'll know that it could mean some short-term volatility in the stock market. You lines understand why your mortgage rate might be going up or why your savings account is suddenly paying a little more interest. This knowledge empowers you to make smarter financial decisions. Maybe you decide to lock in a fixed-rate mortgage before rates go up. Or perhaps you lines rebalance your investment portfolio to be a bit more defensive if you anticipate a period of rising rates. It's about being proactive rather than reactive. understanding the relationship between interest rates, market stability, and your investments in just for Wall Street experts. It is a fundamental piece of financial literacy that can help you build and protect your wealth over the long term. By paying attention to these major economic signals, you're not just watching the news. You're gaining valuable insights into the forces that shape your financial future. So, the next time you see a headline about a central bank meeting, don't just scroll past it. Lean in, listen to what they're saying, and think about how it connects to your own financial goals. It's one of the most important things you can do to take control of your money. Thanks so much for watching today. I hope this breakdown was helpful and made this complex topic a little easier to understand. If you found value in this video, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our next deep dive. Let me know your thoughts in the comments below. See you in the next video.